Good morning. This is your weekly update with Jim Stewart. I'm the Chief Investment Officer here at Worth Asset Management. Today is September 19, 2022, and I'm going to go over your three threes for the week. I'm going to go over the top three market movers. I'm going to also go over last week's big economic data news, which was the CPI, and I'm going to go over our favorite three asset classes and how we are positioned on the short term for both equities and for bonds. So let's jump on in.
Okay, let's go over the top three market movers for the week, September 19, 2022. Number one, we're going to go over economic data from last week, which was the CPI report, and that was a big market mover. And then we're also going to go over number two, which is the FOMC, and they're meeting this week on Tuesday and Wednesday, and what they're going to do with interest rates. And number three, the chart of the week. I actually have three beautiful charts this week, and they're all kind of intertwined on mortgage rates and the SPR. All right, let's talk about what happened last week. On Tuesday, the CPI came out and it came in at 8.3 for August, and it was estimated to come at 8.1. So that was a change, and I'll go into a little bit more detail here in just a second on that. The second big market mover for the week was FedEx. They lowered their guidance, they pulled their forecast. It had its biggest one-day drop in over 40 years. They lost 11 billion in market cap. So the question is this an isolated incident and a one-off, or is this something that we may start seeing in other companies? So we shall see, but it's something we definitely got to keep an eye on. All right, so let's go back now to the CPI. Now, the headline again came in at 8.3 year over year versus an 8.1 estimate, but it was the core CPI that really kind of shook the market because it had gone up only 0.2 from 6.1 to 6.3, but it was the first increase in 6 months. Yes, we all know that energy and oil have started to come down, but everything else, especially in the core CPI, went up. Utilities, vehicles, apparel, shelter, etc., all went up, which caused the core CPI to go up. So that's what shook the market. Did not like to see it, which means they're going to have to continue to raise interest rates. And the market was hoping that we'd start to see some signs that CPI was coming down a little bit more drastically. All right, and that leads us into the pullback this week. And the only positive that we had on a weekly basis was the US dollar coming in at 0.68. Bonds were down 1 to 2%. Our equities were down 3, 4, 5%, with real estate at 6. Gold commodities down 1 to 2 to 2.5. And Bitcoin, which was up 7% last week, was down 7%. So if you zoom out to year to date, still the US dollar and commodities are the only two on the positive side, where everything else is pretty much in double digits, with Bitcoin being the biggest loser, down 57%. All right, so let's talk about what's happening this week. Not only do we have our Fed, but we have the Bank of England and the Bank of Japan having their monetary policy meetings. And two of those three are definitely raising interest rates. The Bank of Japan will probably be doing nothing, as they always typically do, or they may even start easing. They're one of the only areas in the world that is actually not raising interest rates. On Tuesday, we have housing starts, which are estimated to be lower to 1.4 million units. And building permits also down to 1.6 million units. Again, unfortunately, negatives on the housing side. And then, as we said, Wednesday will be the big FOMC meeting and the interest rate decisions, which I'm going to go over. So the Fed is meeting on Tuesday and Wednesday. We'll get the announcement on Wednesday. Well, there's 100% chance that we are at least going up 75 basis points. Okay, this is 100 basis points, which last week was at 0% probability. Now it's up to 14. I don't think they're going to raise 100 basis points. They're probably most likely going to raise 75 basis points here on Wednesday. And also 75 basis points, the probability is 60 in November. So 275 basis point hikes is probably what we're going to see. That's going to get us up to almost 4% here by November 2nd. All right, let's go over the chart of the week. I actually, like I said, I had 3 this week. First one is mortgage payments. So now with rates over 6%, this is the first time since 2008 that we've had interest rates over 6%. And what does that mean? That means that someone who purchased a house, let's just say your neighbor next door is purchasing the very same house next door to you at today's rates. You got your mortgage payment at 1674. Well, they're getting theirs at 2385. That is a huge increase from what you probably got some good interest rates in the 2 to 3% range, and now they're over 6. That is why the demand on the mortgage side has completely dried up. Even though historically 6%, you talk to someone about a house back 70s, 80s, 90s, that's not bad. But over the last 10, 20 years, and with extremely low interest rates, 6% is like, wow, that is extremely high. And so that is why we're seeing a huge demand side on that side just dry up. All right, that leads us into our 30-year mortgage rates versus our rental price percent change. So keep this in mind. When interest rates go up, rents go up. Okay, so there's a high correlation here. Now, why that's important is it's because it's a huge component in our CPI number. And that's one of the reasons why that number went up last month and why the market freaked out a little bit and sold off last week. And that's a very sticky component. Okay, so that's going to continue to go up as interest rates go up. So that is why CPI is probably going to be higher for longer, which is why they're going to have to continue to raise interest rates. Okay, and the third piece, the third chart of the week, is our SPR, which is our Strategic Petroleum Reserve inventory, is shrinking. We are now at the lowest level since 1984. Again, I'm throwing a lot of things out there that are at all-time or 40 or 50, 60-year highs or lows on charts, something we haven't seen in a very, very long time. So now, and that doesn't even include another 8.4 million that was released this week and rumors of 10 million the following month. Okay. Now, typically we're doing this. Okay, the inventory comes down when we have some major problems out there, like Desert Storm. We had an inventory low during this Clinton administration. We had Hurricane Katrina, Arab Spring. What is today's crisis, right? Besides high inflation, what is the crisis that we're trying to avoid right now? Now, what we've got to keep an eye on this. If all of a sudden this drop in our inventory ends in November, I'm going to be, not to get political, I'm going to be very suspect on why they're actually doing this. So we've got to keep an eye on this and see what happens over the next couple months. All right, so let's go over the top 3 asset classes on a long-term basis. Guess what? No change. Defense is still on the field. It's been on the field for primarily most of the year. And T-bills, US dollar, and utilities are still our top 3 asset classes. All right, so let's go over our positioning on the bonds on a short-term basis. Well, as you remember from a couple weeks ago in our video, we went back to protect mode. This is the second time this year that we have done that, avoided most of this drawdown where the bond aggregate index is down 12%. We're back to protect mode. We don't actually own a lot of bonds. Matter of fact, we're actually shorting bonds on some particular investments. All right, let's talk about on the equity side. We've been again, I know this is a busy chart. We go it every week, but we went back to protect mode again for equities. This is our 3rd time this year that we've tried to nibble, tried to get back into equities, and turned around and went right back to protect mode. Well, we've dropped again. You saw last week's huge loss. And now we're sitting again right here at that support zone. And so if, like I said last week, if we drop again below that support zone, we will retest those June lows. But right now we're holding on by just a hair And so we may bounce and trade within these couple ranges here over the next month or two until we get some more data to push us one way or the other. So, all right, that's it for this week. Thank you for joining us. Our next update is Monday, September 26th. And as always, continue to subscribe, like, and comment. And that's it. You have a wonderful week trading. We'll see you guys next week. Thank you.